The money in your bank doesn't actually exist. That sounds like a conspiracy, doesn't it? But this is not a metaphor. If everyone went to their bank tomorrow to withdraw their money, the system would collapse within a few hours because that money isn't there. This is not a mistake, it's a deliberate design. The global financial system operates exactly this way. For centuries we've been living inside a long-standing illusion. It's called fractional reserve banking. This system is the hidden engine behind debt, inflation, and the illusion of wealth. But to understand it, we need to take a step back. Once upon a time in medieval Europe, wealth consisted of gold and silver. If you had money, you kept coins or jewelry in your chest. But carrying these precious metals was risky. So people began entrusting their gold to goldsmiths they considered reliable. In return, the goldsmith would give them a receipt. Bring this paper and receive your gold. Over time, people realized something. If this paper represents the gold, then there's no need to carry gold around. Let's trade with the receipt instead. And that's where the magic began. Goldsmiths noticed that no one came to claim their gold at the same time. Out of 100 customers, maybe only 1 or 2 would withdraw money. So most of the gold in the vaults remained untouched. Then the devil whispered in their ear, "No one notices, why not lend out more than you actually have?" Goldsmiths started issuing more receipts than the gold they possessed. If they had 1,000 gold coins, they would issue 2,000 receipts. They lent out those extra papers and earned interest on them. In other words, they created money out of thin air. And nobody realized it because everyone still trusted those pieces of paper. That's how modern banking was born. Over time, this trick became a system. In 1694, the Bank of England was established not to serve the people but to save the state. The kingdom had been crippled by wars. Bankers lent money to the government, money they didn't actually have, and earned profits in return. In exchange, they received interest payments and tax guarantees. That debt was placed on the shoulders of the public. Does that sound familiar? Because the same thing happens today. America followed the same path. At first, every banknote was backed by gold. But banks quickly realized something. We can print more money than the gold we hold. And with every crisis, every moment of panic, this truth came to light. Most of the money didn't actually exist. But instead of changing the system, governments created an even bigger illusion. They established central banks. From then on, what mattered wasn't whether the money truly existed, but whether people still believed it did. Now let's fast forward to today. Let's say you go to the bank and deposit $100. You think that money is sitting there, right? Wrong. In the past, banks were only required to keep 10% of that amount. They would keep $10 in the vault and lend out the remaining 90 to someone else.
That person would spend the 90. Another person would deposit it in a different bank. And that bank would again lend out most of it. Eventually your $100 would appear as 900 to 1,000 circulating in the economy. But in reality only 10 existed. The rest, debt. And here's the bad news. That old system I just described no longer even applies. Since 2020, banks in the United States have had no reserve requirement at all. Zero. The so-called 10% rule no longer exists. So who controls the system now? The Basel rules. The heads of the world's largest banks meet in the city of Basel, Switzerland to make decisions. Not elected politicians, technocrats. They say the riskier a loan a bank issues, the more of its own capital it must hold as collateral. So it's no longer about how many deposits do you have. It's about how much risk are you taking. Today banks issue loans first and create the corresponding reserves afterward. In other words, credit creates deposits. When you take out a loan, the bank doesn't hand you cash. It simply presses a button and generates new money. That's why more than 90% of the money in circulation today is virtual, created as debt. The consequences can be summed up in 3 main points. 1. Inflation. Because new money is constantly being created, the value of money keeps falling. 2. Endless debt. There's always more debt in the system than can ever be repaid. 3. Concentration of power. Those with wealth grow richer as their assets rise in value while wage earners see their purchasing power shrink. Every crisis, 1929-2008 it doesn't matter, tells the same story. The system depends on its own illusion. When confidence weakens, everything collapses. Yet the same cycle repeats. Governments print money again, patch the system, and we all carry on as if nothing happened. Here are the facts. This system wants you to be in debt. If everyone paid off their loans, economic activity would stop because that money is in fact nothing but debt. So what can we do? First, money is not wealth. Real wealth is land, knowledge, skills, and productive capacity. Second, debt is not innocent. It's the core mechanism that keeps the system alive. Third, inflation is not an accident. It's a built-in feature. This isn't a prophecy of doom. It's a call for awareness. When you understand how the system works, you can question it and stop living like a slave to it. You learn to protect your money, your labor, and your time. From the goldsmiths of the past to today's central banks, one thing hasn't changed: belief. Money exists only as long as people believe in it. And when that belief falters, the cycle begins again. So the next time you look at your bank balance, remember this. Those numbers are just a promise. What truly matters is your knowledge, your skills, and your independence. If you understand the truth, the system can't control you. But if you choose to keep believing, the game goes on.